Could the U.S. government be deliberately crashing the stock market to repay its massive debt? As markets plunged in early 2025, gold prices soared and the dollar collapsed, sparking whispers of secret economic strategies. Welcome back to the channel. Today, we're going to try and uncover the truth behind America's latest financial turmoil. Look, this listener question, it really taps into some serious anxieties, especially given everything we've seen recently.
It does. You hear those whispers, that concern about, unseen forces maybe pulling the strings.
Exactly. So our mission in this deep dive is to really dissect this idea. We're going to look hard at the events of early 2025. We'll see if history offers any similar situations, and then unpack what the experts are saying to figure out if this theory actually holds water.
Right. And to do that properly, we need to examine those past crises, like you said, and compare them to the specifics of what happened in 2025. That's key.
Okay, so let's start there. Historical crisis patterns. Let's talk 2008 and 2020. Now, I don't think anyone seriously believes the government caused those crashes on purpose.
No, definitely not. The origins were very different.
But it's interesting, some of the results, a weaker dollar, gold prices spiking, they sort of align with what our listeners hinting at.
That's a really insightful starting point. Because you're right, after the initial shock wore off in both 2008 and 2020, gold did perform remarkably well. You mentioned the producer price index for gold jumped, 101% between 2008 and 2012? That's huge.
Massive. And 2020 saw record highs, too, pretty quickly.
Yep. And at the same time, the dollar, well, after maybe a brief flight to safety in 2020, it generally weakened in the aftermath of both crises.
And a big reason for that dollar weakness, correct me if I'm wrong, was the Fed's reaction, wasn't it? Slashing rates, quantitative easing.
Precisely. They cut rates down to near zero. They launched massive QE programs, essentially pumping tons of liquidity into the system.
To stop a total meltdown.
Exactly.
Yeah.
But those actions, they naturally weaken the dollar. Lower rates make holding dollars less appealing, and more dollars floating around. Well, that puts pressure on its value.
So investors looked elsewhere, to things like gold.
That's right. Gold doesn't pay interest, so when rates are near zero, the opportunity cost of holding gold drops. Plus, it's seen as a safe haven, especially when the dollar's value is uncertain. One analyst back in '08 basically said the Fed's easing helped sink the dollar, making gold look better.
And that dynamic was even stronger in 2020.
Arguably, yes. Some even suggested gold kind of temporarily replaced the dollar as the main safe bet for a bit there.
Okay, and what about the debt? Because that's central to the listener's question. Debt surged after both crises, right?
Yeah.
Bailouts, stimulus.
Huge increases in U.S. debt. But, and here's the interesting part for this discussion, those rock-bottom interest rates made servicing that new debt much, much cheaper.
Ah, right. Lower borrowing costs.
Lower borrowing costs. And then the inflation that followed later on, it effectively started eating away at the real value of that debt over time.
So you can see the pattern the listener might be picking up on. Weaker dollar, higher gold, debt burden may be eased a bit.
You can see the superficial similarities in the outcomes, yes. But, and this is the crucial difference, the causes were totally different. 2008 was a housing bubble implosion.
Right, internal economic imbalances.
And 2020 was an external shock, a global pandemic. Neither was the government deliberately trying to, crash the system.
That's a key distinction. It's like the symptoms might look similar, but the disease is different.
Exactly.
But you mentioned something about governments indirectly easing debt historically.
Yes, the concept of financial repression. Think post-World War II. Both the U.S. and U.K. had massive debts. They basically kept interest rates artificially low, often below the rate of inflation.
So inflation slowly chips away at the real value of the debt.
Precisely. And the low rates keep the government's interest payments manageable. It's a way to reduce the debt-to-GDP ratio over time without explicitly defaulting or causing hyperinflation.
Okay, so there is precedent for using economic conditions to help manage debt, just not by actively engineering a crash.
Right. Engineering a crash would be, well, unprecedented and incredibly risky. Financial repression is more subtle, more gradual.
Got it. Okay, so let's pivot now to early 2025, because as you said, we did see stocks falling, the dollar weakening and gold surging, all at the same time.
We did. And unlike 2008 or 2020, there was a very clear, specific policy trigger this time.
The tariffs. President Trump's second term, the big Liberation Day tariffs, announced for April 2nd.
Yeah, and the scale was just enormous. A 10% blanket tariff on almost everything, then huge tariffs on China, 25% rising to, 245% on some goods.
Wow.
plus duties on imports from lots of other countries too. This wasn't a tweak, it was a trade earthquake.
And the markets felt it immediately. The S&P 500 dropped over 13% year-to-date by April, NASDAQ down nearly 19%.
Yep, sharp falls. Plunged into correction territory, NASDAQ flirting with a bear market. Investors were clearly spooked.
But here's where it gets really weird, right? What happened with bonds and the dollar? Normally they're safe havens.
That's what made this episode so unusual. Typically, stock market panic sends money flooding into U.S. Treasuries, pushing yields down and often strengthening the dollar, at least initially.
But not this time.
No. This time, Treasury bonds sold off alongside stocks. Yields actually spiked, and the dollar. It hit a 3-year low.
So people were selling everything American. Stocks, bonds, the dollar.
It looked like it. The head of FX at Deutsche Bank called it a simultaneous collapse in the price of all U.S. assets. People were looking for safety somewhere else entirely.
That points to a much deeper loss of confidence, doesn't it? Not just risk-off, but maybe anti-U.S. asset sentiment.
That's certainly how it was interpreted, a sense that global investors had, perhaps temporarily, lost faith in the usual safe havens within the U.S. It's highly atypical.
Okay, so U.S. assets down across the board, but gold.
Gold went parabolic. Absolute tear. Record highs, one after another. It hit something like $3,430 an ounce by late April.
Up 25% just since the start of the year.
Incredible surge. It was the classic safe haven move in the face of massive uncertainty, especially trade war uncertainty.
And the weak dollar helped push it higher too, presumably.
Definitely. Makes gold cheaper for buyers using other currencies. The dollar index, the DXY, slid about 9% year-to-date, down to that 3-year low you mentioned.
And wasn't there also talk about Trump criticizing the Fed again around then? That probably didn't help the dollar.
No, threats against Fed independence always add another layer of uncertainty for markets and for the currency.
But then things shifted again, right? Mid-April, the administration paused the tariff hikes.
Yes. On April 9th, they announced a 90-day pause on further increases. And the market reaction was just instantaneous.
A huge rally.
Massive. S&P 500 jumped nearly 10% in one day. Biggest gain since 2008. NASDAQ soared 12%.
Wow. That really shows how much power those policy announcements had over the market.
Absolutely. It demonstrates the government can influence market direction significantly, which again brings us back to the core question.
Was that initial plunge intentional, maybe for debt reasons, or was it just a policy move that backfired, that went further than they expected?
Exactly. Did they underestimate the market reaction to the tariffs?
Which connects directly to the next piece, the debt wall. Because there was a huge amount of U.S. debt coming due right around then, mid-2025.
That's a critical piece of context. You're talking about roughly $9.3 trillion in government debt maturing in fiscal year 2025.
$9.3 trillion.
Yeah. And over $2.5 trillion of that needed refinancing just by the end of June 2025. A massive wave.
And interest rates were higher by then than when a lot of that debt was first issued, right?
Much higher in many cases.
Yeah.
So organizations like the Peterson Foundation were warning that rolling over this debt at current rates would significantly increase the government's interest costs. A real budget pressure point.
And this was all happening with the debt ceiling back in place too, set at $36.1 trillion.
Yep. And by spring 2025, the Treasury was already using those extraordinary measures, basically accounting maneuvers to avoid hitting the ceiling.
So the X date, the potential default date, was looming. Maybe June or July.
That was the projection, mid-July or possibly even June. It created this atmosphere of significant financial pressure building up.
Which understandably fuels speculation. Did the government look at unconventional options?
Well, it seems some less conventional ideas were certainly being floated or discussed around that time. Things like trying to force foreign creditors to swap their bonds for lower yielding ones.
Seriously?
Yeah, that was mentioned. Selling golden visas for revenue. And most relevant here, this idea of monetizing the asset side.
Meaning the U.S. gold reserves?
Primarily, yes. The U.S. holds a lot of gold, but it's valued on the books at this ancient price, like $42 an ounce.
Which makes it look like only $11 billion or so.
Right. But at the market prices in early 2025, over $3,000 an ounce, that same gold was worth somewhere between $750 and $800 billion.
A huge difference. So people were speculating they might revalue it or sell some.
There was definitely chatter about that, especially after Treasury Secretary Scott Bessent made comments in March about monetizing the asset side.
Did he mean gold specifically?
He didn't explicitly say revalue gold, and later seemed to downplay that specific idea. But the comment itself, in that context, definitely fueled the speculation.
Okay, but it's important to stress, no official ever actually said, we want to crash the market or we want a weaker dollar, right?
Absolutely not. Publicly, before the tariff shock, they were attributing lower long-term rates to market confidence, and that pause on tariffs in April. That strongly suggests they were worried about things getting out of control, particularly in the bond market.
Not pushing things further.
Exactly. It argues against a deliberate crash strategy.
So the idea of using gold, theoretically, higher gold prices and a weaker dollar mean you get more dollars if you sell gold. Could that help with debt?
Theoretically, yes, you could convert gold into more dollars. But the risks are enormous. If you deliberately trash market confidence to achieve that, you could easily end up making your borrowing costs higher, not lower, which is kind of what we saw start to happen with Treasury yields spiking.
Right, it could backfire spectacularly.
Hugely. Plus, even $800 billion from gold, while a lot of money, is still only a fraction of the total U.S. debt. And messing with gold valuation or sales could seriously undermine the dollar's global reserve status. It's a very drastic step.
So a looming debt crunch. Some unconventional talk, but weak evidence for a deliberate crash plan. What were the mainstream experts saying?
Overwhelmingly, the consensus among economists and market analysts was this downturn was a result of policy error, mainly the tariffs, not some secret debt scheme.
They blame the tariffs.
Directly. Reuters poll showed economists sharply downgrading their growth forecasts and hiking recession odds because of the tariffs. They saw it as a major policy mistake.
What were the specific warnings? Lower growth, higher inflation.
Yes. Lower growth, higher inflation from import costs passed on to consumers, damage to business confidence and investment. Crucially, they viewed these as unintended negative side effects, not the goal. Many felt the administration was playing with fire, underestimating the recession risk.
And what about the Fed and all this? If the government wanted to crash, wouldn't they expect the Fed to swoop in with rate cuts?
You'd think so. But the tariffs were inflationary. They pushed up import prices. That put the Fed in a really tough spot. They couldn't easily cut rates to rescue markets if inflation was already picking up steam.
So they were expected to hold steady.
Mostly, yes.
Yeah.
Economists generally thought the Fed would be hesitant to ease because of those inflation risks, which, again, doesn't fit neatly with a coordinated crash and rescue plan.
And the views on gold and the dollar, driven by conspiracy or just fear?
Just fear and uncertainty, according to most experts. Gold was up because of trade war risk, geopolitical tensions, Fed uncertainty. The dollar was down for the same reasons, plus worries about U.S. creditworthiness and maybe the start of some de-dollarization thinking. Standard market reactions to major shocks, not a secret plot.
Even the gold specialists.
Even gold market analysts pointed to those conventional drivers. There was some fringe talk maybe about a Mar-a-Lago Accord to weaken the dollar for trade advantage, but not really linked credibly to debt repayment. And the financial media mostly treated the gold revaluation idea with heavy skepticism, too destabilizing, too complex, more a talking point than real policy.
Okay, so let's look at history again. How does the 2025 tariff shock compare to things like Smoot-Hawley in 1930 or the 2018-19 trade war?
Good comparisons. Smoot-Hawley in 1930 is the classic example. It didn't cause the Great Depression, but by sparking global trade retaliation, it definitely made it much, much worse. A cautionary tale about aggressive tariffs in a fragile economy.
And people were making that comparison in 2025.
Oh yeah, the Smoot-Hawley comparison was definitely being made. And the 2018-19 U.S.-China trade war, while less severe, also rattled markets, slowed global manufacturing, and raised recession fears. It showed tariffs hurt growth and raised prices.
And in both those cases, 1930 and 2018, the goal wasn't to crash the market, right? It was other policy aims. And the negative fallout was maybe underestimated.
Exactly. The tariffs were aimed at protectionism or specific trade concessions. The severe economic damage was likely an unintended or at least underestimated consequence.
And that seems like the most plausible explanation for 2025 as well. Tariffs aimed at, say, reshoring jobs or raising revenue, but the market reaction was just faster and harsher than expected.
That appears to be the case. The severity of the sell-off, especially the coordinated nature across assets, probably took policymakers by surprise, hence the quick pause in April.
Because if the goal was debt management via a crash time for June,
then pausing in April makes no sense. You keep the pressure on or even increase it right up until that debt needed rolling over. Easing off suggests they were trying to prevent a worse crisis, not engineer one.
Right. Even if lower rates and a weaker dollar are side effects that might help with debt down the line, the immediate cost to the economy was looking too high.
Precisely. Plus, tariffs actually increase government revenue, which is a form of fiscal tightening, the opposite of stimulus. And generally, governments with lots of debt try hard to avoid recessions because downturns crush tax receipts and make deficits worse. Willingly causing one seems counterintuitive without extraordinary proof.
Okay, so let's try to pull this all together. Balancing the arguments for and against this idea of an intentional crash for debt reasons.
Okay, on the pro side, or rather this side that fuels the speculation, you have the outcomes, weaker dollar, higher gold that could theoretically help with debt. You have the timing near that big debt wall. You have some unconventional ideas like gold monetization being floated. You have historical precedents sort of for currency devaluation helping debt.
Yeah.
And maybe an unconventional administration willing to consider unusual tactics.
Okay, and the cons, the arguments against it being intentional.
Well, they seem much stronger. The actual market behavior, especially rising bond yields initially, suggests policy error, not a controlled demolition. Deliberately crashing markets is incredibly hard to control and risks making borrowing more expensive. The government paused the tariffs, suggesting concern, not intent. The Fed was cautious due to inflation. Triggering a recession carries huge political risks. There's zero insider evidence. And, as we discussed, the expert consensus points firmly to unintended consequences of trade policy.
And the core logic has issues too, right? The U.S. borrows in its own currency.
Exactly. It doesn't need to crash markets to pay its dollar debts, technically. Selling gold is drastic and limited. Revaluing it is complex and doesn't create instant cash. And intentionally wrecking the dollar's value has massive downsides, like inflation hitting consumers.
So most experts would likely label this a conspiracy theory.
I think that's fair to say. Policy miscalculation, however severe, is just a much more straightforward and evidence-based explanation for what happened in early 2025.
Okay, so wrapping up our deep dive then. The early 2025 market storm looks much more like collateral damage from an aggressive trade policy than some secret master plan to deal with U.S. debt.
That seems to be the most logical conclusion based on the available evidence, yes.
The results might have had some theoretical overlap with what someone trying to manage debt might want: weaker dollar, higher gold, but the actions taken, the expert analysis, the historical context, it all points much more strongly towards unintended consequences and then damage control.
It really underscores how complex these interactions are. Fiscal policy, trade, monetary policy, market sentiment. It's all interconnected, and confidence can be fragile. Small policy moves can have big, unexpected ripple effects.
Which leaves us with a final thought, something maybe for listeners to chew on. Given how massive the U.S. debt actually is, and how willing policymakers might be to consider unconventional tools, what other unexpected things could happen down the road? Could just the fear or perception that the government might try something drastic, even if they aren't, be enough to destabilize markets in the future?
That's a really potent question. Perception can become reality in financial markets sometimes. Definitely something worth thinking about.
Absolutely. Well, thanks for helping us unpack all that today. It's been fascinating.
My pleasure. Always good to dig into these complex issues.
And for everyone listening, if you found this deep dive insightful, please do share it with anyone else you think might be interested in understanding these big financial currents. We'll see you next time.